Let's go across to Alex for the editor's cut. And Alex, a packed house today.
Oh yeah, it's going to be a power-packed session today, Neeraj. And in fact, let me break it down very quickly while the editors are walking onto stage. And the most important factor that we're discussing today, of course, is Bajaj Finance. You saw the numbers: 35% assets under management growth in the third quarter. The question that we're asking is, does that mean that the growth concerns are out of the window, and what does it mean for the rest of the year? The second point is the real estate sector that was just being discussed, and the fact that the real estate index yesterday increased by a whopping 6.7%. What's new? Because this is an index that's gained nearly doubled in the last 12 months, and certain factors like sales have already been discussed. Now, the third one that we're discussing is Grasim. And the rights issue pricing, of course, is in. But the question that we're asking is whether or not the market is pricing in or will price in the paints business that is going to be launched imminently. So let's start with the first one, and that has to do with Bajaj Finance. Harsh, the question stands. Are growth concerns out of the way?
Alex, it seems so, is how I would put it, because it's a second consecutive quarter. I know it's a seasonally strong quarter, and Vishy can probably weigh in. It's a seasonally strong quarter, but it's a 35% growth, especially when your guidance for FY24 is 30%, is quite a beat. And it's not like in Q2 they didn't do that. In Q2 as well, they clocked a 33% year-over-year growth, 7% sequential for a second consecutive quarter. So extremely strong. And this is on the back of two key things which have played out. One, certain RBI restrictions on a couple of their products. Second, the risk-weighted assets being tweaked by the RBI, and it's a double whammy for NBFCs because one, on the lending side of things, RWA has been tweaked, and even on the borrowing side of things, RWA has been tweaked. So it's a double whammy. Of course, margins are going to be key. But at the moment, growth does not seem to be a concern per se.
How have they grown? That's the question, right? Because we were talking earlier and you said 45 days is more or less what they would have had to deal with the change in RWAs, which was supposed to make things costlier for them and was supposed to be a little bit of a barrier for lending. Why have they grown 35%?
So one is they've done a very smart capital raise in November. Sure. It's an equity raise. In a market where they are probably one of the most well-capitalized NBFCs, they've gone ahead and they've done an equity raise. So that's one thing which has given them the confidence to go out and lend. And second, it just seems that their machine seems to be chugging along. There seems to be some level of confidence that they are still able to lend despite all of this, which is a clear sign. I mean, it's not like an NBFC can grow 7% sequential in 45 days. It would be growing through the month, and maybe Vishy can weigh in on that as well. Yeah. So I don't think that it's something that they've tapered off in the last 1.5 months of the quarter. It seems that they've grown consistently through the quarter, and there seems to be a sense of confidence within the
I think if setup. Not devil's advocate, a note of caution is what Vishy is here to talk about.
Yeah, so that's right, Alex. So when you look at the numbers, as Harsh put them out, yes, it looks extremely well done and extremely well placed as a lender in the economy. But let's look at some of the commentary that came in Q2, right? There was a note of caution that Rajiv Jain, the MD and CEO of Bajaj Finance, pointed out with respect to imprudent borrowers and specifically in the rural segment. Of course, there are a few in the urban as well. In Q2, what the company did was reduce their exposure by 8% in the urban areas and about 14% in the rural areas. Now, that doesn't just vanish in one quarter. This is something that is going to last. And if you look at the commentary that Rajiv Jain made, he said that probably around February is when this is expected to turn around, and that we still need to see solid evidence of that improving. One could point to, say, Mahindra Finance, which is a specifically rural lender, and if you would look at their quarterly updates, there as well, they've seen Q3 being a very strong quarter. Of course, Mahindra Finance has its own cyclicalities. So we need to wait and see whether that translates as strongly in the Q4 numbers as well. But as far as Bajaj Finance is concerned, now, yes, there are business restrictions which came in 45 days ago, and to show 35% growth, you need to have grown during that period. My personal thesis is that there is a shift in the portfolio. They are moving towards safer assets because there is a clear risk emanating in the unsecured portfolio, which is very clear by RBI commentary, which is very clear by the FSR notes that they've made. Too many people borrowing too much money, and there needs to be a shift in that. That's what the RBI's caution is. So it's unlikely that a lender of Bajaj Finance's size is unaffected by that.
So possibility that the shift in the texture of the loan book is leading to the growth that we're seeing. We'll get clarity on that in just a bit.
That's right.
The last point on valuations, does it capture that 35% and potential for that kind of run rate?
So, Alex, I'll put it very simply. There's been only 2 times in the last 8 years that Bajaj Finance has traded below 6 times price to book. Currently, it's trading at roughly 6.8 times price to book. The 2 occasions when it was below the 6 times price to book mark was 2016 and 2020. 2020, of course, being that exceptional year. Currently at 6.8 times current price to book, what market analysts are projecting is an upside of 16% from here. Over the 12-month period.
Okay.
So that's where it is. And mind you, it gets that valuation because of asset quality. Never has the net NPA been above 1% since FY 2010.
Okay. All right. So one to watch, certainly. But the real estate pack, Sajeet, 6.7%. It came kind of out of the blue, one would think, at least because the fundamental factors are already factored in, one would think. So what's playing out?
So, if you look at the commentary that we've been hearing in 2023, is that exposure to real estate was mainly through ancillary sectors.
Okay.
Your Century Plies and those kind of companies which are
pipes
companies and everything. Now, look at the holdings of the institutions, mutual funds and FIs. They've been underweight or neutral on real estate for the last whole year when Nifty Realty Index went up by 96%. I was looking at the FI numbers, and these are fortnightly numbers coming out on the NSDL side. The total AUM was around $6.8 billion. It went to $13 billion, and primarily because of asset valuation, not because they have been putting new money.
Right.
The net new money has been only $350 million in 2023.
Wow.
So they are grossly underweight, or then they don't have it. What's changing for the sector? The sector is seeing a pre-sales growth of nearly 30% compared to 15 to 20% in the previous years. This year, FY24, they expect the total value of those sales to cross 1 lakh crores. So assume that top 10 or 12 companies which are part of the Nifty Realty Index, if I look at these companies, we're looking at sales in the next 3 to 4 years, because these have to be executed. These are, accounting norms are there. They have to recognize revenues based on the completion methods. You're looking at the revenue and the profitability flowing in the next 3 to 4 years, and people don't have that kind of, in their portfolio, or they have very limited there. So that's what is driving real estate now. Means institutions are now taking a call saying that, if you are going to bet on the ancillaries, and they have been doing, because they have been doing a lot of capex as well, then it's better also to look at the real estate companies, because they're sitting on that kind of pre-sales numbers.
So what you're suggesting is that this is insti buying that is causing all of this?
It could be insti buying, it could be portfolio building of real estate, because from now on, if you have to deliver that 100,000 crores which they have pre-booked in 2023-24, it has to be done in the next 2 to 3 years, because that's a delivery period for them, and that will translate into revenues, EBITDA and profitability for them. So while the index has jumped, the stocks have jumped. Institutions have been staying away from holding real estate because of various reasons, transparency, accounting issues, everything. But the stocks have run up, and they've been
delivery is also higher, right?
Yeah, delivery is, look at yesterday's volumes. They were up nearly 3.5 times the regular 1 month average volume. Delivery has been higher 2.5 times average 1 month delivery volumes. So there is a holding or buying into that these companies, at least the 10 companies which are part of the Nifty Realty Index. It's been they've seen good amount of buying happening and delivery happening on those companies.
All right, so delivery-based buying in real estate companies. The last topic of the day has to do with Grasim. And the question essentially that we're asking, it's not just about the rights issue. Of course, the rights issue was something that was talked about. The pricing is new. And of course, this is going into the CAPEX plan. And the paints business is part of that. Is the market factoring that in, that paints business?
So to set it in context, the rights issue is around 12% discount to the current market price.
Yes.
It's going to be, they're going to raise 4,000 crores over the next 2 years by March 2026. The paint business is going to be launched in February. The backbone is ready for them. The distribution model is ready for them, and they've tested out in at least 8 to 10 cities for the paint business. If I look at the valuation of Grasim, and I'm putting plain numbers out here for everyone to think, 16 to 17 times forward earnings, which is there. It will have an EPS around 127 rupees or so, and that's giving the current market price for them. Even if I assume that the earnings doesn't go and the paint business top line is going to grow and paint business is going to take 2 years to get profitable, and the earnings remains at the same level of 127 to 130. There's going to be a multiple that's going to build up on Grasim because of the paints business. Grasim today is at
in
16,
2 years.
In 2 years, and market is going to
factor that
in now, right? 16 to 17 times forward earnings is now. Look at Asian Paints; it's 60 times.
Right.
So even if I say that Grasim is not going to be an Asian Paints, it still have a re-rating to say 25 times. What is the price going to be? It's a simple calculation, over 3,000 rupees.
Yeah.
So, so I'm sure that investors in Grasim or shareholders of Grasim are looking at it from that point of view, and the market will start factoring in that re-rating of or the band shift of the PE, which Grasim has been stagnating for the last couple of years, because Grasim is now moving into the paints business, which is much more high growth business for them in that sense.
So then that pricing of the rights issue of 12.5% discount starts looking more juicy.
You'll see active trading in the rights which will be available on the stock exchanges.
Okay.
So that's going to happen going forward from here.
All right. On that note, that brings us to the end of this particularly entertaining and informative edition of the Editor's Cut.